What is up, everyone? So today I want to give a quick update on oil and kind of what's been happening in the oil market for the last 2 weeks. Oil has been steady and continued to climb. Brent is at $73 a barrel and WTI is around 68 bucks a barrel. So it's continued to go up a decent amount, and you're finally starting to see oil stocks start to reflect this and go up quite a bit. I know the XLE has gone up about 10%. XOP, which is another one of my favorite ETFs, has gone up about 10 to 15%. So you're finally starting to see the oil stocks start to reflect this higher oil price environment. And last week we also saw a draw of about 3 million barrels of oil, which was a surprise. So that's why you saw oil rally again. Also, you've had a lot of geopolitical risks. You had the airstrikes in Yemen, and a lot of other things are going on with Iran. There might be reimposed sanctions on Iran, and that is coming up in May. And that's really just like a sweetener. No matter what, we're really starting to see supply and demand even out, and you're starting to see stockpiles go below the 5-year average. So even if sanctions do not get reimposed on Iran, you're seeing the oil market really tighten, and demand is actually starting to exceed supply, and that will continue no matter what for the next year to 2 years. If those sanctions get reimposed on Iran and we try to restrict oil supply that we import from them, that's just a sweetener, and that'll really throw the supply and demand out of whack. And that's when you'll really start to see oil prices rip up if that does happen. Another thing that you're seeing is Venezuela. Their crude production has really dropped in the last year, and it continues to decline, and this is not going to stop in the foreseeable future. You know, Venezuela is really just in a huge mess right now, and it's not going to get any better anytime soon. So you have a lot of factors that really support oil markets from here. There's very, very few downside risks that I see. I know Trump on Friday, I think it was, he tweeted that OPEC is artificially supporting high oil prices, which has always done that in the past. It's done that since OPEC was a thing. I mean, this is what OPEC does. I mean, they try to support higher oil prices because that is what their economy relies very heavily on, is oil prices. A lot of those countries really don't have anything other than oil to support their economy. So obviously they're going to do whatever they can to prop up oil prices. Obviously back in 2014, they did not cut, which is why we saw crude oil go from 100 bucks a barrel all the way down to 28. That was a different situation. You know, OPEC did not want to have to continue to cut and kind of give up market share to US. But with what they did back in 2014 is they really delayed a lot of investment in the oil field, and they've definitely succeeded in that because we've had record low investment in oil and developing new oil fields, and that's really starting to show this last year and going into next year. That's why we're starting to see, you know, demand start to outstrip supply. And that's why you see oil at 70 bucks a barrel. So right now I want to go into my computer screen and I'll show you guys some charts of crude oil and kind of where the ETFs are trading in relation to crude oil prices. So this is a chart of XLE, and this is just a good ETF to kind of use as a benchmark to see, you know, what a lot of crude oil stocks are trading at in comparison to crude oil. And this purple line is crude oil prices. And this is in a percent basis, and the candlestick is XLE, the index. And as you can see, you know, this is still pretty decoupled from actual oil prices. You know, in the last 2 weeks, you have seen a pretty good rally in XLE, but it's still, you know, by a very good margin, pretty decoupled from actual crude oil prices. And as I've talked about in previous videos, you know, this is because a lot of investors just have such negative sentiment on the energy sector as a whole. You know, it's just been beat up for so long. You know, for the past 3 years, we just had such low oil prices that sentiment is, you know, this is always happens too. And, you know, commodities is cyclical. and these booms and busts always happen, and they always shoot to the downside and they always shoot to the upside, which really provides for, if you know where you're at in the cycle, provides an opportunity to really make a lot of money if you know what you're doing and where we're at in the cycle. Because like I said, commodities are cyclical and they shoot to the downside and to the upside at the peak of the cycles. And like I said, we are just starting to see a turn from, the last 3 years of being so oversold, oversupplied in oil stocks, and we're finally starting to see that turn. And it takes a while for investor sentiment to turn positive after it's been negative for so long. So that's kind of why you're seeing this huge decoupling. But like I said, it provides a great buying opportunity. You may have missed out on crude oil rally. Like if you're playing futures, you missed out on a lot of the rally in the crude oil. But commodity stocks, usually do lag commodity prices as a whole. That's actually pretty common, especially when things do start to turn around. It takes a while for the stocks to catch up to actual commodity prices. And this is XES, so this is, like I've talked about this before, it's a little bit riskier of a ETF. I like ETFs because provides a little bit safer. It provides a basket of stocks, so you don't have to go out and pick individual stocks, which and low oil prices can be somewhat risky because if you do pick oil stock that's has a lot of debt, you do run the risk of having that company go bankrupt. That's why I love ETFs. The ETF as a whole, it's not going to go bankrupt. So what we're seeing right now is really interesting how this is playing out. Oil stocks, in my opinion, are still very cheap with where oil is trading at right now. And this presents a very great buying opportunity. If you haven't entered into oil, you really haven't missed out on too much. Obviously, some of these oil stocks have rallied from their lows in the last 1 to 2 months, but they're still very cheap relatively when you compare them to oil prices where they're at right now. So that's it for this video, guys. I just wanted to give a quick update on where we're at in the oil markets today. And I know this isn't as sexy to talk about as tech, like Tesla, Google, Facebook. It's not quite as interesting and stuff like that, but it's definitely where I think that a lot of institutional money is rotating from tech to energy within the last month, and I think you're going to continue to see that. I think tech, a lot of these names like Facebook, Amazon, Google are pretty much fully valued, like they're valued to perfection. So I don't see too much more upside in a lot of those tech names, and that's why I like energy so much. It's so undervalued, and the supply and demand and so many other factors really support oil, higher oil prices from here. So that's why I am so bullish on oil. That's why I have a very big portion of my portfolio allocated towards oil stocks and oil ETFs. And I'm not saying, go rush out and buy all the energy and oil stocks that you can. Higher oil prices aren't a sure thing. Nothing with investing in the stock market is ever a sure thing. There's always risk with anything that you do in investing. So obviously you have to be careful, don't put all your eggs in one basket. Definitely, like I said, I have a lot of eggs in this basket, but make sure you don't put all of them in one basket. So that's it for this video, guys. Thanks for watching, and in the comments down below, go ahead and leave your prediction for what you think crude oil will be in the 1 to 2 year time frame, and also what some of your favorite energy stocks are. So yeah, that's it for this video, guys. Thanks for watching, and I'll see you guys in the next one.